Most people get a personal loan the wrong way. They take the first offer, look only at the monthly payment, and end up paying thousands more than they had to. A personal loan can be one of the smartest tools you have, or an expensive trap. The difference is knowing the process before you start. In this video, I'll walk you through the entire thing, step by step, the way it actually works in 2026, from credit check to money in your account, plus the red flags that should make you walk away. Here's the plan. What a personal loan really is versus other debt, the 7-step process, how lenders actually decide, the soft pull rule that protects your score, how to compare offers correctly, 5 red flags, and a bonus, how to negotiate a better rate after you get an offer. If this is helping, subscribe. I break down real money situations like this every single week. Drop your question in the comments, I read all of them. Okay, let's start with the basics. Let's start with what actually is a personal loan, because mixing it up with other debt is where people lose money. A personal loan is usually an unsecured, fixed-rate installment loan. You borrow a lump sum, you get a fixed monthly payment, and you pay it off over a set term, often 2 to 7 years. No collateral on most of them. Compare that to the alternatives. A credit card is revolving debt with a variable rate that's often much higher, and it tempts you to carry a balance forever. A payday loan is a short-term, extremely high-cost product that can carry triple-digit APRs and trap you in a cycle. A HELOC is secured by your home. Lower rates, but if you can't pay, your house is on the line. So the personal loan sits in a useful middle, more structured and usually cheaper than a credit card or payday loan, and without putting your home at risk like a HELOC. That's why it's a common choice for consolidating debt or covering a big planned expense. Getting a personal loan comes down to 7 clear steps, and knowing them up front is what keeps you from overpaying. Let me walk you through all 7 so nothing surprises you. Step 1. Check your own credit first so you know where you stand. Step 2. Figure out how much you actually need. Borrow the goal, not the maximum. Step 3. Pre-qualify with several lenders using a soft credit check, which doesn't hurt your score. Step 4. Compare the real offers, rate, fees, and term, not just the monthly payment. Step 5. Pick your best fit and submit one formal application, which triggers a hard inquiry. Step 6. The lender verifies your income and documents. Have pay stubs and ID ready. Step 7. You sign and the funds are deposited, often within 1 to a few business days. That's the whole journey. The 2 steps people skip are the first and the third, checking their own credit and pre-qualifying widely before applying. Skip those, and you're flying blind. Do them, and you walk in informed, with leverage. Lenders decide who gets approved using 4 things, not just your credit score, and most people only know about one of them. Here are all 4. First, your credit score and history. Lenders like to see a track record, often at least 2 years of accounts. Second, your debt-to-income ratio. Your monthly debt payments divided by your gross monthly income. As a rule, many lenders prefer this under about 36 to 43%, and lower is better. Third, your income. Steady, verifiable income matters, and some lenders set minimums. Fourth, employment stability. A consistent work history reassures them you can repay. Notice what this means. Your score is important, but it's not the whole story. A solid score with a high DT, I can still get declined, while a fair score with low DTI and steady income can get approved. If you want to improve your odds before applying, the fastest lever for most people is lowering the DTI, paying down a balance, and making sure your credit report is accurate. If you're shopping for a loan, this one rule can protect your credit score, and almost nobody explains it clearly. There are 2 kinds of credit checks. A soft pull happens when you pre-qualify. It shows you estimated rates and odds, and it generally does not affect your score. A hard pull happens when you formally apply, and each one can knock roughly 5 to 10 points off your score. So the smart sequence is simple. Use soft pull pre-qualification to compare several lenders with no damage. Then, once you know your best fit, submit one formal application. One hard pull, not 5. People who skip this apply to 4 or 5 lenders directly and watch their score drop right when they need it most. One note, a pre-qualified estimate isn't a guaranteed final offer. Terms can change after full review, but it's by far the safest way to shop and compare. This is where lenders make the most money off of you, the monthly payment trap. Let me show you how to avoid it. When you compare offers, the number your brain jumps to is the monthly payment. Lower feels better, but a lower monthly payment usually means a longer term. And a longer term means you pay far more interest over the life of the loan. Here's the example. The same loan at the same rate, stretched from 3 years to 6, can cut your monthly payment almost in half. You don't want to see, and roughly double the total interest you pay. The payment looks friendlier, the loan is more expensive, so compare 3 things, not 1. The APR, which includes fees, the total cost over the full term, and only then the monthly payment, to make sure it fits your budget. A free loan calculator, like the one on bankguider.com, lets you plug in real numbers and see total cost versus monthly side by side. Compare on total cost first. The monthly payment is a constraint, not the goal. These are the 5 red flags that should make you walk away from a loan offer, no matter how badly you need the money. Red flag 1. Guaranteed approval. No legitimate lender guarantees approval before reviewing you. It's a marketing trick, and often a predatory one. Red flag 2. No credit check, as a promise. Real lenders check something. No check offers usually hide brutal costs. Red flag 3. Pressure and false urgency. This rate expires tonight. Legitimate offers don't evaporate in hours. Red flag 4. Fees paid upfront before you receive any money. That's a classic advance fee scam. Red flag 5. An APR above 36%. The 36% line comes from the Military Lending Act and is a widely used federal benchmark for what's considered predatory. Above it, be very careful. If you see any of these, close the tab. There are safer options: credit unions, online lenders that work with fair credit, and others we've covered. Desperation is exactly what predatory lenders count on. Slowing down is how you protect yourself. Here's a bonus almost nobody uses. You can often negotiate your rate after you get an offer. Lenders expect it. 3 levers. 1. A competing offer. If another lender pre-qualified you at a lower rate, tell your preferred lender and ask them to match or beat it. Bring the screenshot. 2. Autopay. Many lenders shave a small amount off your APR just for enrolling in automatic payments. Always ask. 3. Your own profile. If your credit improved or your income went up since you pre-qualified, say so. It can justify a better tier. The script is simple and polite. I'd like to move forward, but I have a lower offer from another lender. Can you do better on the rate? The worst they say is no, and you're no worse off. Even a half-point reduction on a multi-year loan can save real money. Asking is free, so ask. Here's the whole video in one line. Check your credit. Pre-qualify widely with soft pulls. Compare on total cost, not the monthly payment. Apply once and negotiate the rate. Do that, and you go from taking whatever you're offered to choosing the best deal on your terms. A personal loan is a tool. Used right, it works for you. If this helped you, subscribe. I break down real money situations like this every single week. Drop your question in the comments. I read all of them. See you next week.